Break down the definition of what a hedge is and how it has helped these producers in the past.
It's essentially just locking in prices. So a lot of these guys, they borrow a lot of money, and the drilling revolution that we've seen in the United States was fueled by debt. And in order to get that debt, a lot of the companies had to promise to lock in oil at a certain price, usually $90, or in some cases there's sort of a below and above price that they use to lock it in. And they do that to protect themselves in the case of a crash. So it's functioned well for a lot of them up until now, when they're going to start running out. And then at that point, they're going to be facing kind of the full force of the crash.
So how much money do some of these producers that were heavily hedged stand to lose?
Well, it's as much as, in the case of SandRidge, which you mentioned, it was 64% of their revenue in the first quarter. We identified, I think, 10 or 15 companies where it was 30% or higher of their revenue. And so these guys are making, a third or a fourth of their money on derivatives rather than on oil and gas drilling. So, that just gives you a sense of the exposure that they're facing once this protection is gone.
So what can they do about that?
I think what they're trying to do is to get their costs down and to learn to drill and to operate in a way that is sustainable. And I think you're seeing that a lot of the best operators are saying that they're already there. Companies like EOG and a few of the other names in the shale patch are saying, we're already there. $65, we make the same amount of money at $65 as we did 2 years ago at $95. But then you've got other companies that are really probably not there. And so they're going to try to seek additional financing, debt financing, equity financing, and tap the capital markets, because they are still spending a lot more money than they're bringing in. Is
that capital still there? I mean, it seems like equity to some extent is drying up. Yes, the credit market is still somewhat available, but if there's a risk-off kind of mentality, junk bonds are not going to be a place where investors want to put their money.
Yeah, that's a good point. I mean, I think the looming question is what will happen with junk bonds. A lot of these producers do have junk ratings, and so it's something that will definitely affect them, whatever happens in that market. I think a lot of the people who follow the E&P world were surprised that the money was even available in the first place in the first quarter. But we tallied it up. I mean, it was $12 billion in equity and $32 billion in debt, so $44 billion for all these companies.
That's
I think
incredible.
People say, it's a huge amount of money, especially with oil, 40 and 50% below what it was. And that's the big surprise. And so, having been surprised before, people are prepared to be surprised again, but they sort of don't know when that will dry up. I mean, that's the looming question. This is one more protection that'll be gone. Sorry.
When these hedges wind up running out, though, does this create the catalyst for potential M&A? I thought we were going to see that months ago. You and I were talking about it quite a bit. Is this going to be the catalyst when an operator like a SandRidge, for example, doesn't have any other choice when it loses these hedges?
That's a great question. I think it's going to be one of the catalysts. So you've got this coming up, and then you have something also coming up in October, which relates to the borrowing base of these companies, basically how much of a top-tier debt that they can borrow from banks. That is based on the reserves of oil and gas that they have in the ground, and as you know, those reserves go down and they're reduced when prices are down. So they're sort of going to get hit by at least those two things, and then potentially even lower prices. So those three things could create a catalyst for sure. What everybody's saying about M&A is that right now you have a problem with valuations. These companies are valued at $80, $85 oil right now, and so nobody wants to overpay. And that's what's keeping M&A from happening.
It's going to get really exciting. I'm pretty pumped for the next 6 months in the oil community. I just want to wrap up here with BP, the company paying a record settlement, about $18.7 billion, resolving some claims of the BP oil spill back in 2010. Can you put that money in perspective for us, and if BP has the cash on hand to pay for it?
Yes, they definitely do. I mean, most of the payments are going to be made over 15 years, so that significantly reduces how much money, and it gives them a huge amount of liquidity. I think everyone that I've spoken to today described it as uniformly positive, less than they expected, and to be paid over a long period of time. There was even a headline I saw that was just kind of saying that BP gets its life back now, which of course was a reference to Tony Hayward's infamous words. But I think the point is that the company mostly now has Macondo behind them with this settlement. There are a few more claims to go, but they are very small in nature compared to these two items that were settled today.